Okay, 11 a.m. Welcome to the webinar, everyone. We'll give just about 10 more seconds for people to come on in, and then we'll get started. Today, August 22nd, 2024, we're going to be doing another webinar on renewable energy, credits, and incentives. It is 11 a.m. Mountain Time, so we're going to be getting started here shortly. Give people 10 more seconds. And before we get started, everyone knows the housekeeping rules for your CPE credit. We're going to have some polling questions. Everyone needs to have 50 minutes and answer at least 3 of the polling questions. And then the Tri-Merit team will submit your CPE, 1 hour of CPE credit for this event. All right, we're going to get started. Here we go. My name is Barry Devine. Been doing specialty tax credit, started doing the research and development tax credit back in 2005. And the last time I announced that I started doing specialty tax in 2005, someone put in the chat, I was in 3rd grade. So been a minute, seen a lot of changes through not only R&D, but cost seg and a lot of, credits and incentives throughout the years. And now I am heading up the energy incentives department here at Tri-Merit, which is, a very, very big market and marketplace. So we're going to get into that today, what the energy transition actually looks like and some more of the details. We do have a special guest today. It was like last minute. I needed our CFO, Nick Pantaleo, to join and talk about some of the details and filing 990Ts we'll get into today. So Nick, do you want to introduce yourself real quick?
Sure. Yeah, so for those who don't know me, Nick Pantaleo, I've been with Tri-Merit for, coming up on 13 years now. One of the partners here, serving the CFO role officially, but unofficially help out with a lot of the tax, kind of digging in deep on some of the technical issues with the team. And honestly, this is going to be mostly a Barry shindig here. I'm here to support with some of the questions on the 990T and what's going on with the IRS there. So with that, take it away, Barry.
Nick is here for the how to actually do it. I'm here for the just the big picture of what it is in a lot of high level. So who is Tri-Merit? A lot of people work with us and they say, what does Tri-Merit mean? Why does it try? Are there 3 things? We say, well, actually, glad you asked. There are 3 things. We feel that there are 3 parts to doing specialty tax and making the specialty tax world better. And one is actually tax. Yeah, go figure. Have CPAs on staff, people that understand working with CPA firms and helping CPAs and their clients understanding the tax and tax implications of specialty tax. Legal, we offer audit representation. So we have lawyers on staff that help with all of our technical knowledge on the front end and the support in the back end. And then founded, by engineers. And since we've, had a history of doing research and development tax credit, a lot of our project managers are actually also PEs. So, if you talk to engineers, it's good to speak their language. So that's the 3 things that represent Tri-Merit. Our current service offerings. We've shifted this a little bit based on how the IRS is kind of structuring these things out of some of the latest legislation. So, of course, research and development, we do Section 41, and unfortunately, we're really good at 174 as well. So we do both of those hand in hand. Of course, when the Inflation Reduction Act hit, we saw the advanced manufacturing, and that was just, our wheelhouse. So we do advanced manufacturing projects, renewable energy incentives, that's your ITCs, PTCs, commercial energy, that's the 179D, energy efficient commercial building deduction, and the 45L credit. And then we do the cost segregation studies as well. So that's just a big picture overview of our service offerings. And just a little bit more of the energy incentives group. It was like, hey, well, we do 179D and 45L and cost seg and manufacturing. And then the Inflation Reduction Act hit, and we were like, wow, this is amazing. I don't know who had a crystal ball to have this line up perfectly for what we do. So we just created this energy incentives group, and we put the 45L, 179D, renewable energy tax credit underneath that. And then when you'll see going down to the credit monetization services, a lot of the presentation today is going to focus on that, because that is one of the number 1 reasons that the Inflation Reduction Act has been such a big deal in the industry, and how it's driving actually implementing these projects. So Learning objectives today, our agenda. Yes, we'll go over the Inflation Reduction Act. I know we've done it many times, and we're celebrating the 2-year anniversary of this legislation being signed. It was August 16th of 2022. And so we're going to talk a little bit about what that looks like. And then since we are celebrating the 2-year anniversary, I thought we would go into what does it look like? How's it being implemented? How, and bottom line, like, how do your clients go get money, right? There's money out there. How do you go get it? So I figure we'll talk about that a little bit today. Of course, we will go to energy credits, bonus credits, not a lot of deep on the calculation, but what that looks like and what the credits are, the amounts, a couple examples, and then we will do credit monetization. Nick is here to walk through the technical aspects of a 990T for elective pay. And then I'm going to finish with transferability. And then, of course, the interplay with other incentives, some planning strategies, what to look for, how do you identify, the activities your clients are doing, and see if they're going to fit in some of these buckets under the Inflation Reduction Act. 2 years ago, this was signed. So most of the credits, they're after, 12/31 of 2022. So 2023 credits, and many of the credits were just credits that or programs that already existed, like the 48 Cap C already existed, right? Solar and wind have been around for 20, 21, 22 years. So a lot of them were revamped, revitalized, and some are new. There's a lot that are new. But just with the Inflation Reduction Act, what the top line estimates, the total revenue raised, and if you heard Biden the other night, he was bragging on his prescription drug pricing reform. And if you follow the IRS, their tax enforcement. So they're claiming to make $739 billion, which is the PAYGO provision, in order to spend $433 billion, going out, and energy security 369. But when you look at some of the just looking like this below, that spend on investment, after the Inflation Reduction Act was signed, Credit Suisse was, saying, well, we don't think it's going to be $433 billion because a lot of these things aren't capped and they're going to go on for a long time. They're like, I think it's going to be $800 billion. And then, Brookings Institution said, well, it's going to be 780. And then Goldman Sachs came out and said, I think the tax cost in 10 years will be 1.2 trillion. So to put that in perspective, the research and development tax credit costs about $10 billion a year. So in a 10-year period, $100 billion is the government's spend on research and development tax credit in order to have that innovation to go back, into our domestic manufacturing and intellectual property. So $100 billion. This, if Goldman Sachs is anywhere close, is 10x of that investment. So big deal, right? Very, very big deal. Lots of dollars, big tax cost. But if it's $1 trillion in 10 years in tax cost, what's the actual spend, right? Well, divide by 6% or 30% or whatever the credits are, or whatever the funding is. So this is why, the investment tax credits and the ITCs are meant to actually install, more, help with this energy transition. And to, yes, less dependency on fossil fuels and lowering everybody's energy cost and having better economics, but also to fill the demand of the energy that we're going to require by 2050. So hoping the ITCs, when 2050 hits, it's going to be, it was like 5.5 billion kilowatt hours that we'll be using. So you can see fossil fuels will be there. It's just increasing renewable energy is a good idea. So the slide everybody hates, and it's just because it's so busy, lots of words, lots of things going on here, but just in that spending, just in the little energy part of the Inflation Reduction Act, this is the table of contents, right? So a lot of agriculture going on, investments in permitting, clean energy financing. We're going to talk about that just a little bit today to touch on that. And then most of what you're going to see, or your clients are going to see, are ITCs and PTCs. So And then we have this 48 cap C, which is the advanced energy project credit. There's a lot of other letters and numbers put together that means significant things that we'll get into a minute, whether it's, 45X versus 48C, or what does 48 do when it becomes 48E. So some different things that we're going to focus on today. So we're going to go into the funding. I thought it would be just a little different shift. We've done this presentation a few times. So if anyone is joining us again, you've probably seen a lot of what it is. So today I thought, why don't we go into some of the funding? Like where does the money come from? How does it, how do we get some, right? So, and I start by, and this is interesting because I start by a quick little story. I was at a conference, and the gentleman who runs the LPO, the Loan Programs Office for the DOE, he has $40 billion that he's trying to administer, and he's giving away this money. So I listened to him speak, and it was, hey, that's really cool. I know, I love what you're doing. And then we're sitting at lunch, and he's like, hey, Barry, you have any ideas of how we can give this money away, this $40 billion? So it was just funny. I was like, oh, you need help giving the money away. And he's like, yes, we need people to understand what the programs are, what qualifies, who should go for it, how's it administered, how does it go? So I'm not involved in that at all, but I could play one tiny little part in sharing with you today on what that looks like. So the LPO has just so many initiatives, right? There are just so many initiatives for, manufacturers and investment, whether it's going to be in the grid or in batteries or in renewable or solar. And there's just a lot of opportunities out there to collect some of this money. The IRA guidebook is a great source. If you want to download that, it kind of summarizes all the programs that we talk about and kind of shows where they fit. I have a general summary today, but it's still, there's a lot going on. So there's really three big pieces of legislation when you get in and start saying, okay, is this 48 cap D, 48 to E, or is it 48 cap C? Or this funding, where does it come from? So the bipartisan infrastructure legislation, the CHIPS and Science Act, and the Inflation Reduction Act. Those are the three big pieces of legislation where if you're just looking at funding, looking at programs, looking at support, looking at, workforce development, training opportunities, manufacturing opportunities, that the most of them are going to come from those three. And they're crossing over a little bit, which I'll explain in just a little bit. So there's other programs, right? There's the state incentives out there. There's a lot infrastructure program. And then if you look at the funding opportunity announcements, they're called FOAs, and they are listed on the DOE's website and the MESC website, which I'll get into. But this is where your clients, if they're asking, hey, how do I get some of this money? How do I, what are the opportunities? How do we get involved? This is a great place to start. So a lot of the funding opportunities will have different, they're going to be focused on different things. This is greenhouse reduction. This is agriculture, right? There's the LPO office too, where the grants facilitate, that it says interstate electricity transmission lines. Wow, that's very specific. And if you go Department of Agriculture programs, you look on there, that second one that says a REAP loan. We have a lot of our clients that are installing solar because they're in a rural area and they're getting these REAP loans. And it's just awesome. And there's people that are helping them get that funding, and then they're installing, and then they're taking the ITCs. So just, looking at, how, on this call, what do you want to get out of it? I don't know, how does legislation get to my client? What does that look like? And how much can my client save? And most importantly, when can they monetize it? So we're going to get to that too, just a little bit more. So there is the MESC, right? Office of Manufacturing and Energy Supply Chains. This is started in 2022. This is a new office, and everybody knows coming out of COVID, we just realized that the infrastructure for supply chain was not good, right? House of cards just did not work for, international and ports and any closures, and then the price went up. So there is now this program is kind of works hand in hand with the DOE, but this one, it has three parts to it: manufacturing capacity, workforce development. Yes, we're going to get into prevailing wage and apprenticeship requirements. Yes, right? Or training, journeyman apprenticeship, like very important. And then they also have a data analysis arm, analysis and strategic investment, they call it. So the MESC, and if you look under the MESC, there I highlighted 48 Cap C. That's one of the ones that we jumped on and wanted to take advantage of. So, there's a lot of other programs under here, and you can see it's, broken into different programs or initiatives that the government wants to promote. Okay. And do we need to do a polling question? Good time for a polling question. Okay. Gonna keep going. Here we go. All right. This is a little bit of the nitty gritty, and it's way too small for anyone to read, but I'll pick one out for you. Domestic manufacturing conversion grants. So this is where if there's people that can help find this money and get this money and qualify for this money. We do the 48 Cap C. There's other programs we're looking at that might fit in our wheelhouse, but this is where the DOE controls like who's going to qualify and what it is and what's the impact. Like what is the impact of this program or this project, and then the MESC is the one that just does a lot of the administrative execution of these programs. So if you look on here, there's funding opportunity announcements, and they'll come in. This says smart manufacturing and recycling, right? The domestic manufacturing conversion grants, heat pump defense production act program. So they'll put out requests for information. They have a teaming partner list of all the people that are on there, and just how to actually see some of the programs and actually apply to go get some. In addition to that, I'm assuming after my conversation with the gentleman that was trying to give away the money, the DOE has now partnered with a third party called EnergyWorks. And if you're from the DOE website and you go to EnergyWorks, it has this is the third party. We're not responsible for their content, but they're going to help us find taxpayers and entities and stakeholders. They call them, the IRS calls them stakeholders, and the program and the money. So there's this third party that it's trying to discover, engage, accelerate innovation, with the development, deployment of these clean energy solutions. So tactically, if you're wondering, like, how do I go from here to here? You go through here. And when you look, I put this little picture here on the right because it's pretty much exactly how the IRS lays it out too, which hey, solar, wind, geo, bio, carbon, nuclear, these are the areas where, whatever industry your client is in or you're working in, it's going to kind of help them, it's going to place them with the actual program. So that was for profits. So the goal is to talk about funding for profits, funding for not-for-profits, and then the monetization of both. Hopefully that is how this plays out. So really quickly, there is another department here, governmental, entity, the state and community energy programs. So if you have any not-for-profits, you're going to find a lot of those strategies through this department, right? Funding strategies, not-for-profits, making the case for energy investments. This is where schools are going to go. All the schools in the north, they want to put in geothermal, right? They're going to go get loans and grants. We're going to go solar, any renewable energy, solution that's right for a not-for-profit. And this is across the board, schools, universities, churches. You can do instrumentalities. And it's even other governmental entities can take advantage of these renewable energy tax credits, not only with funding, but with also taking the ITC in the background. Okay, so moving on, when you look at the programs, right? I put a windmill on my roof. That qualifies. Well, what does that mean? I'm a not-for-profit. I'm a for-profit. I'm an LLC. I'm an S-corp. So most people on the call are familiar with the general business credits, right? That's how R&D, WOTC, 45L, you either do the 6765 or in this case, the 3468. It's going to go in the 3800 and it's going to go as a general business credit. So that's the the tax flow of these actual credits. So you're going to have the form, calculate the credit, the general business credit to get it in the return, and then from there the monetization will happen after that. So 45s are your PTCs. 48 mostly, that's the 3468 form that calculates solar, wind, geothermal, combined heat and power. The CHIPS Act is in there as well. A separate form for the 45X. 48 Cap C is on there, but all of these are going to go as 3800 general business credit. And of course, when it comes in, there's usability rules. It's going to go the 48s. You're going to utilize, if you utilize that credit, you use the first year, the current year first. And if not, you go back 3, then 2, then 1, and it carries forward for 22. So there's rules, with all these 3800 general business credits. So 45 and 48, what are these? Production credits, mainly wind. That's a big one, right? There's some biomass, there's geothermal, there's hydropower production. These are when you're producing renewable energy and selling it. At the end of the year, you get your PTC. On the ITC side, which is 99% of what we see, mainly with geothermal, combined heat and power, and solar. Those are the top 3, and then some biomass projects. So that's mainly what we're seeing coming across in the 48, which is, hey, I spent $1 million this year. I would like my $300,000 credit this year as well. So that is the difference. When you look at, what are some of these? What are some of these credits that clients can take advantage of? So we actually had the good fortune of having the IRS come to our Bridging the Gap conference, which was, and I guess another funny story is we were at an energy conference and we're walking by and we saw one of the sponsors was actually the IRS. So what happens? We said, hey, good to see you here. What are you doing? And they said, well, we're trying to get the word out for renewable energy and helping people understand how they can actually take advantage of them. I was like, well, that's our tagline too. This is great. This is great news. So the IRS, they have stakeholder liaisons in order to help clients with this process, how to use the portal, how to get the registration number, what are the programs. So it's really high level, but they broke it out very nicely. It's not an exact fit, but these are for the carbon. So these are your 45s, soon to be 45Y, your 48, soon to be 48E. And then, some other, 45Q is carbon dioxide sequestration, some other programs, which they just kind of, put, hey, here's clean energy and carbon. And then the next one, they said, okay, what are the credits for manufacturers? These are the facility credits, all right? 45X, that's the advanced manufacturing production credit. That is, you're making something that goes in solar, in wind, inverters, battery, or critical minerals and materials. If you're manufacturing or producing and selling any of those components, you get a price per component as a credit at the end of the year. So this 45X can do both. So when you see transfer and elective pay is if you're a not-for-profit, you get a refundable credit. And if you're transferring, it means you're for-profit and you're going to sell the credit. So that is the 45X is actually refundable for tax-paying entities. And then the 48 Cap C, this is one that we took on. We have a few clients waiting for encouragement letters at the moment. And then we do have a few clients on this, the Manufacturing Investment for CHIPS Act. So the CHIPS and Science Act is different legislation, and it's for making semiconductors. So the legislation is a little bit different. The portal, the registration, the how to monetize is very, very similar, and that is for elective pay as well. And then the last one I put in here, they call it commercial energy, and they call them credits. But so the 45L is the credit for developers, and then they put the energy efficient commercial building deduction under commercial energy as well. So we know it's not a credit, it's a deduction. But they put these two together, which fits really nicely for how we've put our service offerings together for many years. So thank you, IRS. This is really great. So cool. Quick break. We Talked about 48, and a lot of 48 for wind and solar is going to end at the end of this year. So starting 2025 and forward, wind and solar are going to become technology neutral programs. We're still waiting on the the final guidance on here on they want to go net zero. They want the facility to be net zero. So property and facility, is what is the definition that we're waiting on to see if it's net zero. What does that actually mean? And so it doesn't really matter what technology you're using as long as your facility's net zero. So we're still waiting for that to come out. But it's, it's some planning. If you have clients that are thinking about doing solar panels, they should probably get at least 5% done before the end of the year to be, grandfathered in under the old regs. So this is to come from 48 goes to 48E, 45 goes to 45Y. These are more of electricity generated at zero net rules. So back to just the 48s that we're doing currently. Everyone's going to say, oh, you get a 30% credit. Well, the truth is you get a 6% credit, and you get a 30% credit if you're under 1 megawatt or you meet the prevailing wage and apprenticeship requirements. That's how you get to 30%. There is, if you started at least 5% of construction before January 29th, 2023. So a lot of the bigger projects are going to be grandfathered in. So they will not be subject to prevailing wage, and they will get the 30% credit. But the prevailing wage and apprenticeship rules, and I just put a little snippet here from the IRS that it just said, hey, this is just a reminder that prevailing wage is a big deal, and they're going to audit the heck out of it, in my opinion, because it's going to be a very easy lever to pull to say, hey, you did or did not meet this. And the penalties are severe if you don't meet it. $5,000 per laborer. If it's intentional, you're going to pay $10,000 per laborer. So any project over 1 megawatt is going to have to, follow the rules for prevailing wage and apprenticeship rules. And there are software programs, and some of the payroll companies are putting this in there where it goes against, what's the zip code, what's the county, and what is the prevailing wage requirement, and then truing it up as the project is being built. And a little side note here for anyone that calculates a credit does meet prevailing wage, and then they sell that credit 5-year recapture period. Prevailing wage has to be met on all maintenance and repair for that 5-year period. So prevailing wage is a big deal, and it's a big deal because it's important, right? Like we're trying to have better wages, and the apprenticeship requirement where how do we training people? What is the workforce? Like, first of all, who knows how to build this? And then when those people pass it on to the next people, how do they know how to build this? Like it's a lot of, it's a pretty important part of this whole process for our domestic supply chain and workforce training, all those. So here are the IRC, the section, the code section, the credit, and then prevailing wage, and then apprenticeship, needed on some, not needed on some. There's some rules around it as well. And then there is, if you're in an area that you just can't meet the apprenticeship rules, you can get an exception if you can show that you actually tried. So that's the thing. Okay, 6% credit to 30% credit, or even higher, right? So let's just say we have a client, $1 million. Now they put in under 1 megawatt, they're at 30%. Well, they can get to 40, 50, 60, or 70 with these 3 other parts of the bonus credits, they call them. So domestic content. This one was very difficult to qualify for solar. It's changing now, but just the manufacturing was just not enough of the componentry of the products were manufactured in the United States. The geothermal, a lot of geothermal projects can meet the domestic content bonus credit. Some of the combined heat and power, it just depends on what they're doing, where they sourced it from, what those products are. So all domestic steel and iron, 100% has to be U.S. And then it's like a percentage. Your product is a percentage Starts at 40, it's going to go to 45, 45, 45, 50, and then 2027, it's going to flatten out. That 55% of that product or the components of the products on a project have to be manufactured within the United States. So it's been some projects are a little bit easier and some projects are extremely difficult. And a lot of the manufacturers, just the onus came down to the manufacturer to say, hey, I'm buying your product. Does it meet it or not? And so, the manufacturers have not been wanting to share all the costs and details. So there were some final regs on it for, bucketing some cost in order to meet that ratio to hit domestic content. So some people thought it was a little easier than it was in the beginning. So the next 10% bonus, energy community bonus. So under energy community, and there is a map, and a lot of people think this is extremely easy too. Hey, I put my address in and I'm good, right? Well, it's a little bit more complicated than that. So the three different areas: brownfield, metropolitan statistical areas, and coal closure or adjacent, coal closure adjacent. So the lines of where brownfields were drawn are a little bit confusing. The MSA has to meet an unemployment rate, and then the coal closure, there's also like, which ones are, which ones are not. And some people were actually saying, well, hey, we had a coal closure near us and it's not on the map. So there's a little bit more work, but one of the easier ones to hit if you're in certain areas, right? Like West Virginia, they got a lot of qualification. So the other 10% bonus or 20% bonus is the low income community. So it's similar to energy community, but you have to apply in advance. So you have to put your project, your address, your locations in, and then the DOE will come back and tell you whether it's qualified or not. And you have to get like a little certification before you can file your return. So this credit is either a 10% credit or a 20% credit if you're meeting this other criteria. So they are allowing this low income community bonus, but they're maxing it at 1.8 gigawatt of capacity. That was for 2024. So window opens, closes for first come, first serve, and then the next basis is when you go in. This is a first come, first serve. So you got to be you got to be doing this in advance. Okay. I just want to make sure we're doing the polling questions. Did we get those out, Mark?
We've done two of them so far.
I can't see them pop up. Okay, cool. All right, moving on. Okay, second phase here. We're at 11:33. We're looking good. Renewable energy tax credit monetization. So this is the money part, right? This is the money part of the IRA, which we'll say it's money because that's what it is. We're talking about money, right? So how does it work? So who can benefit, right? Like what if I'm a co-op? What if I'm a church? What if I'm a school? I'm a C Corp. I'm an S Corp. It's like basically everyone. Like when we say everyone, we pretty much mean almost everyone, right? Like, so businesses, if you're a for-profit, you can use that credit to offset your tax. Current year, back free, forward 22. Or what you can do is you can sell your credit. If you're not for profit, right? If you're an applicable entity, they call it, you have an option to have a refundable credit. So that's what Nick is going to get into in just a minute. So just very quickly looking at the registrant types, right? So the code section 6417, that's everything you need to know for that not-for-profit, for the applicable entities, for using elective pay, also called direct pay sometimes, and getting a refund for your credit. 6418 is the rules you need for selling your credit. It's called transferring a credit, transferability. So this table just shows what kind of registrant type are you, right? You're a government, Alaska Indian, tribal, tax exempt organization. So if you're a P, that means you're going to take this is option for elective pay. If you're a T, C Corp, S Corp, partnership, you can transfer them. If you're a T, some of them are both. Say 45X, you do both. 48D is all elective pay because it's a refundable credit. That's the CHIPS Act. So that table allows you to know whether you can have transfer or elective pay per entity or what entity you are. So the monetization wheel, this is something we put together just to help clients. If you have a client, you say, hey, they are thinking about, doing a solar project, but they're a school and they don't know what that means. And they don't even know what tax credits are. And you said 3,800 general business credit and they got scared. So basically the monetization, and normally we'll provide the feasibility analysis. And a lot of people do feasibilities up front, right? So technical review, credit evaluation, like throw out like, what's the value of the credit? If you spend $1 million and put the solar panel on your church, when your tax year ends, more or less on this date, you're going to be able to get a check for $300,000 from the government. And when you can lay that out for the client and show the client journey, it's eye-opening, and it helps. I mean, they have bond financing and boards, and it's a group decision on whether we can spend that money. So showing, hey, this is when money can re-enter the bank account, that really helps. So the administration, this is getting the client, signing the contract to do the work and getting on the IRS portal as fast as possible. And then we're gonna go into that in just a minute. The due diligence, the due diligence is the package. Excuse me. It is also called a cost seg study. It is called a renewable energy tax credit study. Has a lot of names, a validation package, but the due diligence is doing the work, providing the forms, and then the monetization, and that's what we'll get into currently. So for the not-for-profits, here's a list of applicable entities. Here's how you get started on the process. Here's the IRS portal registration. Then you have the diligence. Then you make the elective pay. This is where you calculate the credit on that 3468 form. 3468 form goes to the 3800. Registration number from the IRS portal goes to that 3800. And that is going to then go to the 990T in order to receive that refund, which is the money move. That's it. That's where you receive the payment. That's why we're doing it all. So the IRS portal, it has the Inflation Reduction Act in it and the CHIPS Act. So I told you there's two different pieces of legislation, but they're both in the same portal. And a lot of clients get confused, even on the first page. We're like, okay, go sign up. And they're like, well, I don't know, what that means. So you got to register your intent to make elective payment or transfer election. So the elective pay and transferability are going to follow the same process in the portal until the end. And you're going to be a T or a P. So you have to have a representative from the entity has to have an ID.me account, create a new account. And then from that account, you're going to go in and you're going to put all of the property or, with the credit that's on that property, how many registrations you're going to need, how many projects, how many properties are all going to be in there. And then there's a sam.gov register on the side. So here's some things that you just need to know about going in, and your clients need to know about. The IRS did put out a very, very, very good guideline on how to walk through it. And then we actually took that and kind of made our own version of it. So it helps all the clients understand how to do it. So big picture, how do I take this 3,800 to get a 990? Well, you got to earn a credit. There's 5 modules in that portal. There's general information, there's credit specific information. You pick your form that's coming in. The IRS originally asked for 120 days before you file your return, so they have time to review your request to have elective pay. So the eco account ID.me, 120 days, and then this is where you can file your return. Just a little bit more of what that portal looks like when the clients come in. Facility property, yeah, you got to put latitude and longitude, subsidiary, EIN. You got to have this information in that portal. These are the credits to choose from. This is what it's going to look like when you're in there choosing. And then, so the IRS does have a lot of information on, hey, what is elective pay? Who qualifies? What does that look like? So all of these are available on their site and application, what applicable entities. So now taking this information and just very quickly saying, okay, I get it. I have a credit. I have a credit. It's calculated. I'm going to do this 3,800. How do I do that? So the IRS, just on August 14th, sent out this email, said, hey, you need to be in. If you're doing this, you need to go in now. So I'm going to turn it over to Nick right now, and he's going to explain just tactically, what does it look like, 990T, some things that we've seen, and just share a little bit of information from what we've learned.
Yeah, so most of the process and most of the timeline lies in what Barry just covered, right? You need to go get that registration in place and do it as soon as possible. They state the 120 days. Don't quote us on this, but we've seen it go a little quicker than that. I don't know if you can get it done in time for October 15th, but some of the more recent registrations would lead us to believe that it is still possible. It's not too late. Also, if you have clients, specifically nonprofits, who aren't normally required to file a 990T, their deadline is later. It's the 5th month, right? So it'd be, in this example, it kind of shows it here, May 15th, 2024. Or if you're getting an extension, which you don't have to file for an extension if you are working with a company who doesn't normally file a 990T. There's one of these, 6417 applicable entities, they automatically get the extension all the way to November. So you're not too late. You haven't missed it for all these clients. If they do have something at play and they don't even know it, or they haven't, taken a look at it. So want to make sure everyone understood that with this, get the transfer election as soon as you can inside the portal, because without that, you can't take, advantage of the elective payment as a nonprofit. So get that first, what that time looks like. As far as the 990T itself, I'll give credit to the IRS. They made this really simple, right? They made it as simple as they possibly could. The 990T itself, you're just taking the information from the 3,800, which comes from the 3468. You're transferring that all over to the 990T just on a couple lines, right? So you fill out the top, with whatever your company is, and then it's literally, we'll look at the next couple of pages, but don't go there yet, Barry. But just a couple spots, you fill in the credit number with the elective payment, you're good to go. But go back to the last page real quick. I want to cover a couple of things.
Yeah.
What the IRS is doing, though, is they are forcing everyone to e-file. So whether you've normally done 990T or not, you do need to e-file. So it is preventing a lot of companies from being able to do this themselves. They have to work through someone who has e-filing capability. And that's where the CPA world comes into play. You may not be working with these clients currently. They might come to you saying, hey, we need someone who can do this for us, right? Do this filing. So that is going to be funneling work to the CPA. So everyone should be aware of that. It's not near as daunting as a normal 990. It's a really simple process for the 990T. With the one update they made, usually a 990T, you had to be some type of 501 organization or a couple other types. But with this 6417, section that went into play, there is an option for entities that fall under that, and that's pretty much government organizations. There are, a list of them. There's native groups as well, but in general, it's government organizations who weren't normally filing, who need a way to be able to claim this credit. So that's why that came into play. So when you get to the 990T, you'll see there's a 6417D1A entity option. That's what it's for. People who aren't normally filing 990Ts, they come in and claim this credit. You just check the box. But again, you need to have Form 3800 along with the corresponding 3468 prepared to flow through the 990T. Those are the more complicated parts, and we can't get into those here because there's tons of options depending on which credit you're taking. But how it flows through the 990T is pretty simple. So now go to the next page, Barry.
Yes, sir.
So if you are one of these, municipalities, cities, anything like that, it's just simple checkbox for the organization type. This is actually causing issues with the e-filers, which I'll get to in a second. But because this wasn't an option before now, before the 2022 IRA brought it to be, you always had the other organization types, right? A 501c or corp or a trust, 401a trust or other trust. There is a state college university as well. But they didn't have the 6417 because it didn't exist. So now that it does exist, it's on the form. Unfortunately, the e-filing providers are having issues with being able to accommodate this. We'll get to that in a second. I'll touch on that a little bit further, what you can do about it. But Just go ahead and click the next slide, Barry.
Mm-hmm.
So this is the spot. This is the spot where the credit goes. You bring it through to 6G. You then copy that same amount to line 7, 10, and 11. And that's how you're claiming this elective payment. So when I say they made it simple for the 990T purposes, I mean, it is to the point simple, one line you fill out. You do have to put zeros in a couple spots in section 2 above where it talks about proxy tax. I didn't specifically call that out, but again, this is where the credit flows through, and that's how you claim it. So if you're a company, you have a company comes to you, they're like, hey, we need this done. We've never done a filing before. Don't have to panic like, oh gosh, there's all this stuff that we can have with unrelated business income or anything like that. No, it's just like this. That's all it's for. 990Ts was traditionally for unrelated business income and for proxy tax, but they've adapted it for this purpose as well for the nonprofits. So go ahead and click the next one, Barry. So with the 6417, the thing I'll lean to, a lot of these e-filing providers, they're not ready for it. And they've had time, but maybe just the application hasn't been there for them to work out. So what we've seen, we use Listcert. I know people use all different kinds of programs out there. They're having trouble being able to allow a filing with this 6417 D18 designation. And other companies have seen the same. So here's what they've done. They've made this nice and really short email. irs.elective.payment.or.transfer.credit at irs.gov. So you can reach out to them here. And when you do that, you can essentially explain, hey, we can't e-file because our provider can't accommodate this entity type. They will then respond with instructions, essentially giving you an exemption to paper file. They'll tell you where to file it. We're working through this with our first one now. So we're hoping to have details like, hey, is it always going to the same spot? Do you need to go through this step of reaching out to them to say, hey, we need to file it at this location? Or are they just going to let you essentially say, yeah, just file it to that location, include a copy of your first paper rejection letter, and ask for an exemption? Do you even need to get that first paper rejection letter? Those are little things we're trying to work through nuances with them and figure out, and I'll hopefully have more on a future webinar for that. But as of now, they recognize that this is an issue, that people don't have ways to always e-file these. So you're preparing a lot of these forms manually and getting them sent in by paper filing after they give you the address when you reach out to this address. So that's where that process stands now. It's not the most ideal, but again, the positive is they have recognized that there is an issue there. They have some workaround solution in place to be able to do this. Just know if you're in your program trying to do this, not every program can handle the e-filing with this entity type. So if you get a city that comes to you, that's who we're working with. We're working with the city right now, doing the filing, and there's just no way to e-file it. So, yeah.
Cool.
And then, here's a little case study. Illinois School District, they had a $4 million mechanical system improvement project, geothermal, which, as Barry said, it's a big thing happening in the north right now. A lot of schools are putting in geothermal. So you kind of see the property cost, and they did have the 30% plus the content bonus, which, as Barry said, not easy to do with the content bonus, tracing that back. There's a lot of information you got to gather for that. But so you have a school who's a nonprofit, they have $4 million spent on this project, and they're thinking it's going to take, 10, 15 years maybe to realize a benefit, being kind of neutral on that investment. Well, now you have a $1.6 million credit, which they can take an elective pay. And important distinction, right? It's a credit, but when you file this on your 3800 980T, they're treating it as a payment against zero tax. That's how they're getting around the whole credit concept when it's a nonprofit who can't really offset any tax. They're saying this is simply a tax payment. That's what the elective pay option means. So then that payment gets essentially refunded to you, and they're just going to get a check back. Literally, like Barry said, a check back from the government for $1.6 million, offsetting, in this case, 40% of the cost of getting this in place. So it is a big deal, and they are pushing this everywhere. But I mean, you can see when you see the numbers work out, you can see the investment that the government's making to try to help build this infrastructure and opening up to nonprofits who are looking to do these things. already, like it's just going to help stimulate it more. So it might be an underserved, population that's out there. As CPAs, is something to be aware of, that these people might be looking for guidance on this.
Mm-hmm. All right. Thank you, Nick. That was very, very informative. And thank you for putting that email in there. That was for the IRS. That was, thank you for bringing levity to filing a 990T. That is just fantastic. And if you guys want more, nerdy tax jokes, we're full of them. We got funny email addresses left and right. Okay. That was 6417. We're going to go to 6418, one number away, but a totally different thing. So this is for the for-profits. Pursuing a credit. Complete the form. IRS pre-filing registration, very important. Due diligence, that's tri-merit, going to work, doing the study, validation work, due diligence package, and to transfer the statement. It all looks the same, 3468, 3800. Then it's going to go to a transfer election statement and a tax credit transfer agreement where you have a buyer. So let's jump into it just a little bit. These are the 11 credits that are eligible for transfer. Pretty much mostly all of them that we talked about, right? And just right under 48 has all of your solar, wind, geo. So this is how the IRS said their process is, and they made it really simple as well. I don't know if it's simple or just really high level. They're just like, pursue a credit, satisfy the requirements, arrange to sell it, do this statement, and file your returns. That's it. So there's no template or anything for the transfer election statement, but that is what goes from the seller to the buyer. So if you break down 6418, it kind of shakes out into there's 6 parts of the transfer election statement. And the last one is just, a statement of representation from the eligible taxpayer to the, like did the seller give the buyer everything they need, right? Did they do that? So what we're saying is see due diligence package. So I'm trying merit and it'll have everything you need in it. So the final regs were issued on this. We were waiting for a very long time, but they did come out. Summary of the regs. You can go find everything you need to know about the recapture. You cannot separate the credit adders. So you can't say, hey, I'll just sell you my 30% credit, but not domestic content and low income. If you slice it, you have to slice it vertically, right? So you cannot additionally transfer, right? There's partnership impacts. If you sell your credit, you get the money, and then your partnership splits up, someone leaves. Passive activity loss rules, right? This is probably the biggest part of this, where if you are buying the credit and you're a C Corp, that's fine. It's going to offset your income tax. If you're a flow through, it is subject passive activity loss rules, which means at the end of the day, it offsets passive income only. So we were hoping that wouldn't happen, but it did. It's kind of an anti-fraud or anti-abuse measure. So, good for the IRS, because after PPP and ERC, they're tired of fraud and they think this is going to be the next area, which they're probably not wrong. So transfer election process. So what does this look like? The eligible property, eligible credit, eligible taxpayer. That's everything on the seller, which is the transferor, goes to the transferee. Transferee is the buyer who becomes the taxpayer, meaning if the IRS audits, who do they audit? The taxpayer, which is the buyer. So the onus is on the buyer to make sure they're buying a good credit, and any recapture is going to have to be repaid at 120% because it's, the excess plus 20% penalty has to be made in cash. And then there's, adjusted basis, not gross receipts, and then the credit goes in the buyer's return. So just to look at that a little bit more, connecting buyers and sellers, you can split, let's say like on the right over here, we have renewable asset, diligent study, eligible credit 10 million. If you're, let's say you're a CPA firm and you have clients that have 300 or 500 or 5 million or 200,000, 4 million in appetite, you could just buy one $10 million credit and divide that credit up. It can be divided up. So it could be that credit, you can put insurance on that credit, buy that credit, one registration number, one insurance policy, one credit, and multiple buyers that take the breakout and the registration number in each of their 3,800. So behind the scenes, the IRS is going to take that registration number, add up those dollars, and make sure the registration number on the other side equals 10 million. So they're kind of triangulating all the data to make sure that happens. So We're not going to get into a lot of recapture or insurance, but I think in the future we're going to get into that. Pricing considerations. This is like, what if I'm going to sell a credit, how much am I going to get? Well, if you have a really big PTCs are after the fact, so there's no recapture. A lot of the PTCs, they used to go for like 97 cents on the dollar. Now they go between 93 to 95 cents on the dollar. So a big corporate buyer at the end of the year, there's no recapture risk. Like, hey, do you want to save 7% on your tax bill? Sure, done. ITCs are going about 82 cents on the dollar. They're going from 80 to 85 to 86 cents on the dollar. That means the buyer, hey, would you like to save 15% on your tax bill that's already due to Uncle Sam right now? And seller, would you like 85 cents on your credit? So that's how the pricing is happening. And the pricing is just a negotiation. It just depends on what time of year is it? What's the technology, right? Is it solar? Is it wind? Is it, where's it located? Who did the work? So just example credits, right? There's an ITC, combined heat and power. This is one $3.4 million credit. So when you're going to, if you have clients that want to offset tax, you could go in and you have the details of the credit. But the top things are, what is the project? What is the technology? Capacity? What's the location? How was it financed? Is there going to be, any foreclosure activities? Is it ITC, PTC? What's the credit amount? What about those 10% bonus credits that we talked about that were like not as easy as we thought they were? Did you do all of that? And so doing that and having the proper, diligence, that's how it works. So that is a real high level of what it looks like of taking a credit and finding a buyer. There's just a lot in between. There are credit exchanges out there that you can just put your credit up and buyer can go in and buy them, and they're all unrelated parties, or you could do a more intimate sale where we know the client, we know the financing, we did the work. You're a CPA, you have a buyer, the buyer, the tax liability, and we work together that way. So if we can do a webinar 1 year from this date to date, and I promise you it will all be fleshed out and a lot different than we see it now. So here we go, 3 minutes left. Planning strategies, evaluate projects. Are things being built? Are they being planned? Is there any, what are your projects looking at? Are they going to spend money? Do they have money? Do they have tax? Are they in any of these areas? Do they want to go find the money? So, optimizing ITCs, if you're in there in the beginning looking at the property, there's some, interconnectivity and, interdependent rules on things that qualify and things that don't when you get, deep in 48. So it might help to optimize the ITC. The placed in service is really critical. If you are doing solar, you probably want to be 5% before the end of the year, depending on what the 48 to 48E difference is going to look like. So just understanding, all of the prevailing wage, that's just such a big deal. And then also looking at if you're going to, like a lot of things are, if you do the 48 cap C in your facility, you can't take the 45X, but like, can you do R&D based on your expenses? Because these two are on capital cost. Like the answer is yes. And so there's some conflicting credits, some designations for facilities that, prevent you from doing certain things. And there's also a lot of interplay, which like we love going into renewable energy because there's R&D like everywhere, all the manufacturers and all the processes. So look for multiple opportunities, right? One of our geothermal projects, they did an expansion. So they had a cost seg study. They qualified for 179D because of the geothermal, and they qualified geothermal just under Section 48. So, it was a bundled service, a 48, a 179D, and a cost seg all in one shot for the company and the entity and the client, which is critical because all three of those are going to affect the basis. So the basis has to be correct for all three of those. So just looking at the multiple opportunities is very critical in these situations for your client and saving your clients money And then those are the planning strategies moving forward. So it's 12 o'clock right now. So this is our last slide. We are wrapping it up, but looking at multiple opportunities and maximizing the savings. Do they need deductions? Do they need credits? Do they want credits? They want to sell the credit, not for profits. Seems like a lot, but just with the right preliminary conversation, you can take your client down the right path. Here's the Venn diagram that we call the Venn diagram. So, there's a lot of players. There's a lot of, government entities, organizations. I shared with you some new, departments that are out there, and then just all these new opportunities. Finding the right partner is critical. And we just can't stress that enough because of all the different players in here, from engineering, procurement, construction, install, manufacturer, the client, the CPA, specialty tax. Find the right partners. Thank you everyone for joining us. 12:01, we're going to let you go. Don't forget to get your CPE credit, and we'll see you next time. Bye-bye.